Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions.
Hey there, investors. So, it looks like the market has hit a bit of a rocky patch lately, with the correction territory being entered. In times like these, it's important to exercise some caution. Now, let me hit you with a fun fact to brighten up your day. Did you know that way back in 1792, a group of 24 stockbrokers and merchants came together and signed something called the Buttonwood Agreement? And guess where they did it? Under a good old buttonwood tree right on Wall Street in New York City. This agreement ended up being the starting point of what we now know as the New York Stock Exchange. Those were the days. Unfortunately, the Buttonwood tree is long gone now. But thinking about those traders coming together under its shady branches reminds us of the rich history of the stock market. But let's get back to the present. With the market going through a correction, it might be a good time to think about being a little more cautious with your investments. Keep an eye on the GDP growth and how it could impact the stock market. It's always a smart move to stay informed and make decisions based on the current economic landscape. Stay tuned for more updates on personal finance, economics, and markets. Remember, being informed is key in this ever-changing world of investments. In economic news, the US GDP grew at a 4.9% annual pace in the third quarter, surpassing the expected figure of 4.7%. This growth rate, which takes into account inflation, is the highest since the fourth quarter of 2021. So why did the GDP increase? Well, there were several contributing factors. Increased inventories, exports, residential investment, and government spending all played a role in driving up the GDP figures. Notably, consumer spending increased by 4%, accounting for 7 percentage points of the overall GDP increase. Inventories also made a significant contribution of 3 percentage points. Additionally, gross private domestic investment experienced a surge of 4%, and government spending and investment jumped by 6%. While the unexpected rise in consumer spending is certainly positive, experts believe that we have already seen enough hikes in spending this year. Moving on to other news, the Labor Department reported that jobless claims totaled 210,000 for the week ended October 21st. This is an increase of 10,000 from the previous period, and slightly higher than the Dow Jones estimate of 207,000. In global news, mortgage rates have climbed higher and are now edging closer to 8%. The United Auto Workers Union and Ford have reached a tentative labor agreement, which is an important development for the automotive industry. Additionally, Siemens Energy shares have seen a significant decline of 35% as the company seeks support from the German government. Lastly, Turkey's central bank has raised interest rates from 30% to 35% to address economic issues. So let's talk about stocks. The S&P 500 and NASDAQ have taken a bit of a hit recently, landing them in what's called correction territory. What caused this? Well, it's a combination of high treasury yields and disappointing numbers from tech companies. One tech giant that made headlines was Amazon. They announced their earnings, and it seems like a bit of a mixed bag. On the good side, their adjusted earnings per share came in at $0.94, exceeding expectations of $0.58. Revenues also showed promise, reaching $143, $1 billion compared to the expected $141, $4 billion. A bright spot for them was their advertising revenue, which brought in $12, $1 billion, surpassing estimates of $11, $6 billion. But it wasn't all sunshine and rainbows for Amazon. Their Amazon Web Services, which is a big moneymaker for them, fell short with a revenue of $23, $1 billion, missing expectations by $10 billion. To counter slower growth, Amazon has been focused on cost optimization. They've made some tough decisions like laying off 27,000 employees and shutting down unprofitable initiatives. In these uncertain times, it's important to keep a watchful eye on the stock market and how companies are performing. It's always a roller coaster ride, and the key is to stay informed and be prepared for any twists and turns that may come our way. So let's dive into the latest news in the world of digital coins. You won't believe what happened to Binance founder CZ. Brace yourself. He lost a whopping $12 billion due to a crypto trading slump. That's a massive hit for anyone. even in the volatile world of cryptocurrencies. It just goes to show that even the industry's big players can't escape market fluctuations. In another courtroom drama, we have the crypto king himself, who goes by the name FTX. He recently informed a judge that his actions were based on legal advice. It seems like legal arguments are playing a role in the crypto world, highlighting the complexities that arise when dealing with these digital assets. It'll be interesting to see how this case unfolds and the implications it might have on the industry as a whole. Moving over to Taiwan, we see progress in crypto regulation with the first reading of the Digital Asset Bill. This is a significant step towards establishing a legal framework in this rapidly expanding sector. With a clear set of rules in place, it can bring more stability and trust to the market, attracting new participants and boosting innovation. That's a wrap for today's crypto update. Stay tuned for more exciting news in the digital coin space, where fortunes can rise and fall in the blink of an eye. Are stock portfolios going out of fashion? It's a question worth exploring. In the past, investing in stocks and bonds was considered the winning formula. But times are changing, and now we have better options to consider. The value of longer-term treasury yields has hit a 16-year high, causing their value to drop. And stocks? Well, they're also expensive right now. So it might be time for investors to look elsewhere. But does that mean the stock market is a bad choice? Not necessarily. The S&P 500 index is still offering great results. However, most experts agree that it has peaked. The chart data for 2023 shows it standing at 48% so far. UBS, a well-known financial institution, has revised its forecast and expects the S&P 500 to hit 4,700 points by December 2024 instead of mid-year, due to expectations of higher U.S. interest rates. When comparing stocks to real estate, stocks have historically outperformed real estate over time. From March 1992 to March 2022, the U.S. average growth rate was 3%, while the S&P 500 returned 65% annually over the same period when assuming dividends were reinvested. So, if you're considering alternatives, here are a few options. First, real estate investment trusts, REITs. These allow you to benefit from the real estate industry without investing millions. REITs invest in various types of real estate, such as housing, commercial buildings, hotels, and warehouses, and distribute rental proceeds to owners. Next, there's gold. In today's environment, gold can be a great investment option. You can invest in gold bullion, coins, mining companies, futures contracts, or mutual funds that focus on gold. Just keep in mind that if you choose physical gold, you'll need a safe place to store it, like a bank's safe deposit box. Lastly, commodities futures can be both risky and rewarding. Options include grain, corn, and cotton. However, it's important to be cautious, as external conditions can have a significant impact on commodity prices. In conclusion, while stocks should remain a part of your portfolio, it's wise to adjust your expectations. We may not see the same level of returns as we did from 2019 to 2021, so explore other options and diversify your investments wisely. Have you ever stopped to think about the stock market? It's this fascinating world where people are constantly buying and selling, trying to make a profit. But here's the thing, not everyone is in it for the right reasons. Some folks are solely focused on the price of stocks without considering their actual value. This brings us to today's personal finance quote by Philip Fisher. The stock market is filled with individuals who know the price of everything, but the value of nothing. And let me tell you, truer words have never been spoken. You see, it's easy to get caught up in the hype of the stock market. We hear about hot stocks and booming industries, and we want to cash in on the excitement. But what we often forget is that behind those numbers, there is a real value, the value of the company we're investing in. Understanding the value of a stock is crucial for making sound financial decisions. It's not just about how much you paid for it or how much you can sell it for. It's about the company's fundamentals, their growth potential, and their ability to generate profits. So the next time you dive into the stock market, remember the wise words of Philip Fisher. Don't just focus on the price, but dig deeper to understand the true value of the stocks you're investing in. That's how you can navigate this market with confidence and make informed choices for your financial future.
In today's episode, we discuss the cautious outlook for the market despite growing US GDP, the various factors contributing to the growth, the correction territory of the S&P 500 and NASDAQ, the latest headlines in cryptocurrency, the shift away from stock portfolios, and the wise words of Philip Fisher on stock market knowledge. Thanks for tuning into the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at Morning Download. Come subscribe.